Good morning, Matt. How are you?
Hey, Jan. Good morning.
And good morning, everyone. Thanks for joining. We're putting some information in the chat, and we also have the Q&A functionality. So hope to engage that later on. Uh, just by way of background, Matt Sigel is a digital asset strategist at VanEck. He's also the manager of an actively managed ETF that invests in digital asset equities and tokens indirectly, generally. But you never know how the regulations will change. Matt's very active on crypto Twitter or X, the platform X. So there's a lot of content and that he provides and his opinions on the ecosystem, which is great. I'm very excited to be on with him this morning. So basically, I have two objectives for today. Number one, to know exactly what's going to happen. I say this sarcastically with Bitcoin in the future. And secondly, to give a rubric for thinking about how to allocate to Bitcoin. So this is not a Bitcoin 101 presentation. This is I have the ability to own Bitcoin or I own it already. What should I be thinking about in terms of allocating to Bitcoin? And this came out of a very helpful discussion that we had with a to be not named global private bank in Midtown, and Matt was giving them his insights, and I said, "Wow, these are the three things he's kind of basically talking about." So, Matt, before we get to the three things, what's your view on the Bitcoin price?
Yeah, we're still quite constructive on Bitcoin price through the end of the year. So we were buying the dip on Friday when BTC fell down to 104K. I think that a lot of the fears in the market were macro driven around the potential for a credit cycle and some of the disclosures in the US regional banking system. And personally, I think those fears are overblown. And when we look at the equity space, kind of the crypto equity space at the moment, it's intertwined with the AI trade because so many of the Bitcoin miners have pivoted a portion of their electricity supply to serve that market. And if you look at the debt being offered in the AI part of the market, there's still a lot of new issues being brought to market that are being priced very tight, even relative to the conditions of a few weeks ago. So on the same day that all these regional fears came out, the largest ever AI infra deal in the debt markets was sealed. It's a Meta data center in Louisiana, $30 billion project, and that debt is being rated A plus by S&P.
Okay. All right.
Yeah,
Before we
yeah.
get into too deep, so Q4 bullish, 2026 Bitcoin.
2026, if the 4-year cycle holds, then, I think a lot of investors are going to be more
So the
cautious.
4-year cycle, just to interrupt, is the what I would call an on-chain phenomenon. The way Bitcoin is programmed, and the rewards from mining Bitcoin are halved, right, every 4 years. And typically, um, the year that is to come would be bearish for Bitcoin. So your answer?
My answer is that it depends where we end the year for Bitcoin. So I'm not married to the 4-year cycle that as soon as calendar 2026 starts, we have to be negative. I think there's one more like large upside move to catch up with gold. Gold and Bitcoin tend to take turns. Gold is at kind of all-time high relative to its moving averages. In the past, some of that optimism has migrated to the Bitcoin market. So I'm looking for, at least one kind of major top accompanied by signs of euphoria. And that's what we're going to get into in this presentation is kind of a little bit of how to identify those signs of euphoria. And if that happens in Q4, then, 2026 could be a tougher year. If for some reason we're sideways through Q4, then, maybe that upside comes in Q1 or maybe it doesn't come at all.
Okay, so my version of that is don't let one particular data point, such as the halving cycle, drive your asset allocation to Bitcoin. Instead, we're going to propose a three-prong analysis. So Matt, maybe if you could bring that up, and the basics are, I'll speak and then I'll turn the deck over to you. Number one is global liquidity. So just like gold, perhaps, is a reflection as a store of value asset of global liquidity conditions, so is Bitcoin. So we'll talk about that, number one. Number two, within the crypto ecosystem, I'll call it, are there signs of euphoria and excessive leverage? Just like you'd have perhaps like high margin ratios in the equity market, margin borrowing, stock margin borrowing. What does that look like? And then third, we are talking about technology. There is activity on the Bitcoin blockchain and other blockchains. What are those indicators signaling? So Matt, over to you.
Okay, yeah. So let's take a look at kind of each of those three lenses in kind. The first being global liquidity, which is really a macro call. So it's one that, personally, I hesitate to make inside of a crypto portfolio, but it's definitely the one that moves the asset class the most reliably. So simple data, which I think everyone feels, which is that the BTC price change correlates highly with changes in global M2. We estimate that changes in global M2 explain over 50% of Bitcoin's variance. And that is true across most countries. So here we've broken it out across the major countries: US, EU, UK, Japan, and China. In fact, the US M2 is the smallest explanatory measure of Bitcoin's move in the context of all these other M2s. But I think that this goes back to the main point that M2 is often just the inverse of the dollar. So, when you track M2, it tends to be reported in US dollars by many of the data providers. And so here you can see that Bitcoin has a strong negative correlation with the DXY. So this is negative 0.5, this is negative 1. So that negative correlation has eased somewhat over the last 5 or 6 years, but it's still very strong. So when the dollar is weak, then more liquidity in other countries creates more in dollars because the dollar is going down. And that's why it's so difficult to make I think personally, a tactical call on M2 is because you're basically making a call on the dollar, and very few people can do that with any type of consistency on a short-term basis. So on the long term, many people are in Bitcoin to protect themselves against fiat devaluation and the fact that central bank balance sheets have grown so much faster than underlying measures of CPI inflation. So Bitcoin protects investors against monetary inflation, and that's most common when the dollar is weak. Does that make sense? They're all kind of interlinked.
Yeah, big picture though, taking a step back, I would say that developed market central banks are easing. And so we're effectively the US is actually the slowest, I think, of the leading countries to be easing. So we're kind of in a relaxed, I would say, global liquidity environment. Is that a fair summary?
Yeah, I tend to agree. It's very simple. Don't fight the Fed, but it is true that when interest rates are falling, there tends to be more liquidity and more economic activity to come. So that I think is a good, simple heuristic for Fed is cutting. You need really strong reasons to be bearish on Bitcoin.
All right. So green light from a global liquidity perspective, and I think we put in the chat a link to an interview I did in 23 where I discussed that factor as well as one of the reasons for the house getting bullish on Bitcoin and gold in 2023. Okay, Matt.
Okay, so next category is leverage within the digital assets ecosystem. And here we have the correlation of Bitcoin price to Bitcoin futures open interest. which is leverage expressed in the futures market. And here, again, correlation extremely high. We estimate that since October of 2020, nearly 73% of Bitcoin's movements can be explained by the changes in open interest in Bitcoin futures. There are periodic breakdowns during periods where other factors have a bigger influence on the BTC price. But even when these breakdowns occur, the correlation is still above 0.5, so it's material. Next slide here. Oops, sorry. Okay. Wow, we're really on delay here on our slides. Hold on. Okay, one more forward. Okay. This is a very volatile series in terms of the daily movements, but over a 90-day moving average, you can see that the open interest in Bitcoin futures, does play a material role in the price change. So the simple beta of Bitcoin to the change in open interest averages around 0.68, but during volatile periods, it can grow to more than 2x. And this gets to the reflexivity inherent in this asset class. And we saw that with a flash crash a couple of weeks ago. So I think there's a lot of immaturity around how digital assets positioned are financed. Many of the world's largest banks and brokers still do not provide financing into this space, and that makes the prices very susceptible to changes in leverage. So where are we right now? We estimate that leverage in the Bitcoin futures system currently sits around its 95th percentile, meaning that only 5% of the time has there ever been more leverage in the Bitcoin market. But I caution against reading too much into this 95th percentile, because if and as Bitcoin matures into an alternative source of money, and we think that's happening before our eyes with 10 sovereign nations now mining Bitcoin with resources from the central government, that it makes sense that leverage will rise over time. And so the question when allocating tactically to Bitcoin is just over the short term, when there's really rapid increases in leverage, that can be a negative indicator for forward returns. Same thing in the Bitcoin options market. So the open interest on Bitcoin options has increased 5-fold since the last Bitcoin bull market. It's currently at peak levels, and that has coincided with the decline in Bitcoin realized volatility. So that's one of the reasons we think why each subsequent Bitcoin cycle has been smaller, is because the volatility of the asset has also declined over the years. And in September, it hit an all-time low of 27% annualized. That didn't linger. We just saw a big increase in that. But the main point is that structurally, leverage in the system is rising. We just have to be on the lookout for when that happens too fast. And this is a good chart that explains, I think, my comment about the structural nature of Bitcoin leverage. When we look at open interest in the options market as a percentage of the notional, for US equities, open interest is close to 22%. In the crude oil market, close to 7%. Bitcoin 2.5%, gold 1.5%. So high relative to very stable gold, but it's certainly an argument that this asset class can and will likely support higher levels of debt going forward. So that's kind of the structural. How about the tactical? This is the basis yield that investors can currently earn by buying the spot market and selling the BTC futures market. So this is commonly known as the basis trade. And this series charts the annualized return for basis trade participants. And what you can see is that there tends to be large spikes in this series when risk appetite is extremely high, tends to correlate with local tops in the market. Although, there's some argument that this yield is now being suppressed by alternative ways to express this trade, like Athena, which is a blockchain project that essentially performs the basis trade and then sells a token to investors for them to capture the profits from the basis trade. So this series, leaves us pretty bullish because there's no sign of real euphoria in the futures market. And we have some data here that shows that when these basis yields are below 7%, the forward returns are, very, very positive. 2-year basis, if history is past this prologue, you were in 170% 2 years when basis trade is very low. But when you get into the double digits, and that's these pink bars, you can see how the 2-year returns deteriorate quite a bit. So that's the sign of euphoria, and typically we try to take some chips off the table when we sense euphoria. Another way to think about how much leverage is in the system is by looking at leveraged ETFs. So there's lots of kind of 2x, 3x Bitcoin products that are trading as ETFs. We estimate roughly 4 billion in assets that are inside of these levered ETFs. This chart doesn't look particularly scary from a pace of increase basis. And then when we compare how much levered ETFs are there relative to Bitcoin's market cap, we estimate that levered Bitcoin ETF exposure represents around 0.2% of Bitcoin market cap. For gold ETFs, it's closer to 0.5. For silver, it's closer to 0.3. So doesn't look like leveraged ETF investors are driving too much euphoria in the space. And then the last part of the market that we look at to analyze the levels of leverage is how much is being borrowed on chain. So Bitcoin represents about 15% of all the collateral that's used in decentralized finance. You can see how these leverage ratios have pretty much been stable at around 40%. So there's been a big increase in leverage in the system. Most of that's on Ethereum, and a lot of that is driven by tighter integration between TradFi rails and DeFi rails. So we can debate, bears will debate whether this is a structural trend that we think it is, but until we see some major change in the second derivative, the leverage ratio, we wouldn't be too concerned about the leverage levels at these levels. Digital asset treasuries, these are companies like MicroStrategy, who have become the biggest buyers of Bitcoin over the last year. Here we have seen a big pickup from roughly $4 billion in debt to $12 billion. It should be noted that 96% of all of that debt is held in one issue, MicroStrategy, who has built an entire yield curve of Bitcoin-backed debt, including half a dozen convertible bonds, a number of preferred securities, of course, the common equity. So that stock has underperformed for the last 6 months and reflects, I think, a kind of consensus bearishness about the structure of these digital asset treasury companies. We've been pretty underweight the sector. We didn't really participate much on the way up, and nor have we caught a lot of that downside. I guess if I were to paint the silver lining on this, it's that the common equity and the number of shares that MicroStrategy and the other digital asset treasury companies have sold, most of this leverage is actually just showing up as dilution. It's not so pleasurable for the common equity holders, but in the context of MicroStrategy's asset base, they're still less than 20% debt to equity. So they can survive an 80% Bitcoin downdraft without any forced selling, we estimate. Bitcoin miners, they've also increased their debt quite a bit. So it was, 5 billion a couple years ago, now north of 20 billion. But I would say that most of the Bitcoin miners have announced these pivots to AI, and most of the debt that we're looking at on this is actually backed by investors who are funding the repurposing of Bitcoin data centers into AI data centers. So I do think that a credit cycle would hurt these stocks. They're still, very levered. But if AI were to work and Bitcoin didn't, then a lot of this debt is still, I think, sustainable.
Matt, as we end the second, the discussion of the second factor, right? Leverage within the crypto ecosystem. I'll add a comment and then ask you a question. So, for those of us like myself, who's more of a TradFi investor, and I'm not looking all these charts on the basis trade and all this kind of stuff within the leverage within the crypto ecosystem. My signal is, when does it hit the headlines of the Wall Street Journal? And I use the other extreme. So Matt is helpfully looking at sort of exuberance or worrisome exuberance within the system, like too much leverage. I've also used the opposite. So when you had the FTX collapse and the Biden administration crackdown on crypto, and the most extreme was when they were asking market makers, crypto market makers, to kind of pull back on their activities. That was a real pullback on liquidity within the ecosystem and to me, a potential buying signal, not in the short term, but and I think this sort of mini crash that we had 10 days ago in the markets, clearly there was a level of liquidation that happened, and it kind of pulled back. I wouldn't say it was dramatic enough to be a buy signal, but it is something that I watch without looking at all these kind of more detailed charts. Now, that was Jan's comment on the sort of second leverage within the crypto ecosystem factor. There's a question that for you, I mean, you were looking at data around Bitcoin futures on the CME. This question is about Bitcoin ETFs. Did they make leverage in Bitcoin more difficult for you to determine with precision? Does that make sense?
Yeah, I think they make it easier because there is now a liquid options market on a number of the Bitcoin ETFs, and that data can be tracked quite precisely. So that's how we get this, open interest as a percentage of the market for Bitcoin, is by including the ETF. So I think that what the number one thing that the election catalyzed in terms of actionable changes in market structure due to policy loosening was Wall Street integration with Bitcoin. All of the largest global investment banks essentially now making markets on these ETFs and implicitly providing leverage into the space. So yeah, I don't think it's made it harder to analyze. I think that it's just kind of added to the use of responsible leverage in the space. Last cycle, most of the leverage came from unregulated tech companies like Celsius, BlockFi, right? These were tech founders essentially who didn't have maybe the TradFi financial risk procedures that were required, and that's changed. So the leverage is now coming more from traditional Wall Street. We can debate whether that's going to be more responsible. I think there's some case that it will be.
Okay, great. All right, let's keep going then.
Okay, so we're on to our third category, which is on-chain activity.
And sorry,
And
just to interrupt here for a second. Again, we at VanEck are trying to make all this data more accessible to you. So Matt writes a monthly summary of all this on-chain stuff, which most of us in the traditional financial world are not looking at all and probably wouldn't know where to look, even though it's all on the internet. So anyway, thank you, Matt, for doing that update. And I just wanted to refer listeners to that. But take us away here.
yeah, so we track a number of kind of key performance indicators across the top several dozen blockchains, and we're on the hunt for which of those KPIs have the highest correlation with the token price itself. So here we have a series that looks at Ethereum, Solana, Bitcoin, Binance, SWI, and AVAX. What's the simple correlation between the revenues and we define that as fees that users pay to make on-chain transactions, and the actual token price. And so these vary pretty widely. I think what's interesting from this is that, Solana is the highest. So you can really see that Solana's fees are very volatile and often driven by meme coin volumes. So the correlation between Solana revenues and the token price above 0.8. Bitcoin is quite a bit lower, and it's fallen, right? So Bitcoin was 0.8 right around
So
the time.
Bitcoin's in the yellow line here.
Yep, right around the time when the ETFs launched, and it's fallen from 0.8 down to 0.4 as I would say like the store of value narrative for ETFs and corporates has proliferated. So that's one observation we can make. And then there's also, we can look at the correlation between the token price and daily active users on the blockchain. So not how much they spend, but just how many are there. And here you can see that the correlations are lower. Some of them are even negative for some of the newer projects, but generally between 0.2 and 0.6, so kind of a low to medium correlation. And for Bitcoin, that's actually been rising over time. So when we look at on-chain data to inform buy or sell decisions, one of the most reliable indicators is the amount of unrealized profits that holders have. So unlike in traditional finance, where we get maybe quarterly reports about who owns what equities, so it makes it harder to track folks' positions in real time. On the Bitcoin blockchain, you can see the price that every coin was transacted, and if the holder has profits or losses. And here we have a measure of the unrealized profit ratio. When the number is low, below 0.6 on our ratio, the forward returns are all very positive. As unrealized profits get higher, these forward returns deteriorate. And in the blue bars, when you have a relative unrealized profit ratio of above 0.7, you have negative returns across all time periods. So we had we actually had none of these supercell signals over the last year, but we've had the mini cell signals. And we use these as kind of indicators of euphoria and pent up selling pressure. I guess one piece of the Bitcoin microstructure or the market structure that we also track is during what time periods is Bitcoin seeing its greatest returns or its biggest selling? And here there's been a change in the last couple of years. So in the last bull market, Bitcoin had its weakest performance during the Asian trading hours. And what we've seen over the last couple of years is that actually Asian buying has accelerated. So, perhaps that's because of the stronger de-dollarization trends in Asia. We've observed a lot of the central bank buying is coming from China and other parts of Asia. China's Bitcoin ban, so to speak, there was some relaxation of the enforcement. We still estimate that a significant part of Bitcoin hash rate is coming from Asia. So point here is just that Asia seems to become more bullish on this asset class. And then in the last couple of weeks, which is not reflected in this chart, we noticed that when Bitcoin sold off, the sell-off was actually bigger in Asia. So perhaps some of this leverage accumulated more in Asia, perhaps with China and India now in the markets defending their currencies. That's not great for local liquidity in those markets. And so Bitcoin has maybe reacted to that. But we do use these regional data to inform our analysis of who's buying and who's selling.
Great. So let me summarize and get to your question. So basically, three things we look at: global liquidity, leverage within the crypto ecosystem, and then on-chain activity. Matt, I'm going to ask what I would consider to be an on-chain or technical kind of question, which is what are the quantum compute risks to Bitcoin?
Yeah, the biggest risk is that an old crypto wallet, and many of those old crypto wallets used when they generated the private keys, the random number generators that they used were not totally pristine. So they may not have generated totally random numbers, and that makes those old wallets theoretically easier to hack. So I think the biggest fear from folks who are worried about quantum is that, a Satoshi era wallet could have their coins stolen if the wallet owner doesn't upgrade to a newer wallet with quantum secure signature schemes. And there are some wallets that have quantum secure signature schemes, just that the entire ecosystem, Bitcoin ecosystem, has not coalesced around one such standard.
Great, that's interesting. I didn't know that. So the system is already kind of responding to the quantum risk, or users are, I should say.
Yes.
Got it. So several minutes ago, you talked about buying on the dip on Friday. It's an interesting question. Are you buying on the open market, or are you buying from private market makers or dark pools?
We in the strategy that I'm managing, we are either buying ETFs, where we're buying on exchanges using traditional broker dealers to make markets in those ETFs, and then we have token strategies where we interact either on exchanges like Coinbase and Kraken, or we interact with liquidity providers, so market makers.
All of the above.
All of the above.
Okay, and then coming up on the last question, I'll just remind people, if you do have any thoughts or questions on how we think about allocating to Bitcoin, this is a good time because we're going to close it up in a couple of minutes here. But so I would call this, sorry, my view just got blocked. Do you see, Matt, a change, big or small, when staking ETFs of Solana and ETH get approved?
I mean, there's definitely going to be a change in that. For the Ethereum ETFs, I'd say a majority of the assets in those ETFs will end up being staked. So I think that's positive for the investor experience. Staked Ethereum has outperformed unstaked Ethereum by, last I looked, it was like 3,000 basis points over 3 years. So it's like 10 percentage points a year. It's a material difference. You're forced to buy the dip when your assets are staked. And I think that'll, mute some of the volatility and hopefully entice some technology investors to add these ETFs to their, tech portfolios. That's the biggest change I think that I'll see. Yeah, I think it's going to be material.
That's interesting. Because there was the sort of second part of the question was a thesis that maybe there would be more net demand because they're getting income, quote unquote. from their ETH and Solana holdings. So interesting. Okay. Sorry, just let me see here. Oh wow, a lot of questions came in. I'm just going to read this. Based on the 4-year cycle, this is kind of going to the top of the discussion here, Matt. Based on the 4-year cycle, has the October performance surprised you? I guess this is really the Q4 question. Do you expect a strong November? Do you think something has changed?
Yeah, I mean, I thought it was an all-time liquidation event a couple of Fridays ago, right? So that tends to reset the leverage in the system and provide a backdrop for some upside. So, of course, something can change if we go through a macro event, if there's, a credit crunch driven by these regional banking concerns. It's possible. But my bet is that those concerns reflect a narrow part of the economy centered on old industry, and the backdrop for AI-driven financing needs is still, very strong, and Bitcoin should correlate with that. So market tends to punish consensus thinking, and coming into October, just all over my feed, October. So I think this is the fake out that really I saw some frustration with how Bitcoin's acting versus gold, and a lot more crypto people just on the timeline like, oh, when can gold hit 10K? Like all this gold stuff that when you look back in the last few years, they tend to take turns. So I think we're going to see, as the gold momentum kind of eases, some of that find its way into Bitcoin. I think that's happening this morning.
Got it. So with the distortion coming from Athena and funding rates, are signs of euphoria becoming less reliable? Are digital asset treasury companies themselves sign of euphoria?
Yeah, I think that's a
Great
great
question.
question. Great
And
question.
the last part is, what other signals of euphoria do you think could be new to this cycle? That's a great question.
Yeah, it is. It is. I mean, so I think the DATs did soak up some of the speculative energies that typically would have gone into leverage, and instead they went into dilution. So I think it's less of a systemic issue. That's not to say it's positive. If you were buying one of these smaller cap DATs, and they're, many of them are now trading well below NAV with no real roadmap to getting back above NAV, not a good experience. It could make some people disillusioned and less willing to put a marginal dollar into the space, but it's not going to end with the type of counterparty risk that we saw when the leverage was unregulated, like with the GBTC, trading at a discount back in 2022, or FTX, these types of the leverage is more visible. I think that goes back to the question someone asked about, is it hard to identify because of the ETF? No, I think it's easier. I think a lot of the leverage has been integrated into the financial system. So as for the other signals, one thing I didn't call out here was like the qualitative. We look at things like Coinbase app downloads or Phantom Wallet app downloads, and when these things spike and become top top downloaded apps, that also tends to be kind of a counter-cyclical sign of euphoria.
I'm going to take a comment here. So just 1 or 2 questions left, and if we don't get more, we'll close it down. But I really like this comment. It says one remark. Wow. I'll just read it because it's hard to summarize. But one remark for me: how do you gauge risk as digital assets become more institutional? Basis trades get crowded. Both the leverage parameters as well as the on-chain parameters seem to drift off and have to be recalibrated on a continuous basis. You have that on the radar screen, obviously, and we kind of weaved it into the discussion, but maybe something worth discussing on a pod in a deeper basis.
Yeah, Dominic, thanks for the question. I think it's a good one. If you're bullish on this asset and you think like we do that Bitcoin has the potential to reach millions of dollars per coin and be used as a large-scale settlement currency in global trade, be held by central banks. It's now held, by the Luxembourg Sovereign Wealth Fund, as an example. So we continue to see signs of adoption, and therefore, I think that we can't be too scared to see leverage ratios at their all-time highs. Like, it would be natural to be at their all-time highs as Bitcoin matures. So I'm, more worried about the second derivatives and how quickly something happens than its absolute scale until Bitcoin is more widely adopted. I did see one question on here, Jan, that I thought was a good one. Someone
I'm going
sent
there.
before it was asking about like a fundamental value for Bitcoin.
Okay, go. I missed that. Go ahead.
Yeah, so it was asking like how do we think about Bitcoin's kind of intrinsic value? Is there any type of support for the valuation? And one thing that we can look at is the cost to mine a coin, and we can track kind of the aggregate profit margins of Bitcoin miners. The average gross profit margin is around 60%, so pretty healthy gross profit margins, and that is the case right now as well. But if you look back in history, the price doesn't tend to fall below that kind of marginal cost of production for very, very long. So similar to other commodity markets where it's hard for the market structure to sustain when the price is below the cost of production. That'd be one thing that we look at.
I don't want to get into any particular funds, Matt, but what's your feeling about owning MicroStrategy or Strategy? I mean, it's something that's in your universe, right? Let's just say that, right?
Yeah, for sure. It's a huge part of my universe. And one of we've learned from the cycles over time that leverage and Bitcoin, are not a great mixture.
For the long term, for sure.
It's a very volatile asset with, we think, a lot of asymmetric upside, and I don't feel a huge incentive to add leverage on top of that. So in a lot of crypto equity indices, MicroStrategy can be a 10% weight, and these digital asset treasury companies can be up to 20% of the index. Our investment process is that we are underweight leverage structurally. And so MicroStrategy is more like a 2 or 3% position in the portfolio that I'm managing. I think there's a case that one or two of these digital asset treasury companies can trade at a premium over the cycle because of their access to the capital markets. I think that Saylor's direct relationships with the largest convertible bond trading desks on Wall Street are moats of a kind. But that doesn't extend to the long tail of small caps. And so we're very careful in this space and underweight relative to what the market cap would imply.
All right, I'm going to go to a kind of question about the first consideration, which is global liquidity. And the question is, do you expect the Genius Act, allowing bank reserves as collateral, to impact liquidity broadly? Will the $3 trillion in bank reserves be unlocked as previously idle liquidity? I will add my comment on the Genius Act and let Matt expound. But I really think that the stablecoin bill of the summer, passed on a bipartisan basis, is one of the third most radical pieces of bank legislation in U.S. history. It effectively allows technology companies to compete against banks in the payment system. So that's a slightly different point than whether they will compete for bank reserves. I think that's a second kind of question. So let me turn it over to you, Matt, on that front.
Yeah, I think stablecoins are competing with bank deposits. And like you said, every technology company can now become a bank. This is the year of bank charters. There have been 22 bank charter applications in the US this year, and a third of them are from companies with crypto DNA. So to the extent that stablecoins are taking market share from bank deposits, it's probably a negative for liquidity in the short term, right? Because all of those stablecoin assets go into T-bills. Whereas when you put your deposits in Chase, they're lending to the Telluride Four Seasons, literally, right? That's their latest, right? So you've got this huge risk mismatch, duration mismatch from the banks. That's literally what creates money, though, is that they take your deposits and loan them out. So I think one of the questions for the market is, can the private credit industry, which structurally has been taking market share from banks for a decade now, like, will they continue to pick up that slack and create money at the same pace as the banks, even if the banks are losing share of deposits? T-bill market, yeah, it makes liquidity. T-bills are going to love this. The question is whether some of these, loans that banks would typically make are going to have a hard time getting funded.
I'm going to add something cryptic and then we can wrap it up, which is, to me, which is really an inside baseball kind of financial world kind of thing. But I think the most interesting thing about blockchain is the cross-collateralization opportunities, as much as just sort of flat out competition. So there are asset classes that are, in a way, like home equity loans, maybe locked up to a certain extent, or segregated within someone's portfolio, or balance sheet, where crypto broadly or blockchain allows maybe a broader holistic view of that. But Matt, let's just, any final comments? So I think that, again, the main point we were trying to emphasize is a lot of investment committees these days, especially heading into year end, we were saying, wow, I've got these Bitcoin thingies that I can allocate to, and maybe I just allocate 1 or 2%. And our answer is, look at your views on global liquidity to establish your capital asset model. Look at global liquidity, look at liquidity within the crypto ecosystem, and then sort of on-chain economics. Would you weight those three factors, Matt, for us in ending? Sorry, that's a surprise question.
Okay, well, Bitcoin's correlation to the NASDAQ has been higher in the post-COVID period, right? So it used to be that Bitcoin had no persistent correlation with the NASDAQ, and now it's in the 0.5 range. And many have observed rightly that there's higher correlation among all risk assets, and Bitcoin for now is trading like a risk asset. So I would say that the first category is probably the most important. Maybe like 60%, and then leverage within the system is like 25%, and then the on-chain activity is 10 to 15%. That's kind of a snapshot of my current thinking, but that can change.
Great answer. Thank you, Matt, for your insights today. And I'll refer everyone to Matt's Twitter account, which is posted in the chat, and obviously the on-chain content and lots of other contents available on our website at VanEck.com. Thank you. Thanks, Matt, for putting this together. It's great, detailed, but also high level.
Yeah, thanks for the time, everyone.